when it comes to investing, most people don't do very well in it. You know, there are reports that retail investors actually underperform market performance by a lot simply because there's a lot of mistakes made everywhere. Today I'm going to share with you one in particular. You know, everybody wants to be that Warren Buffett, but Warren Buffett, there's only one of him, simply because he has exceptional discipline, simply because he approaches the stock investing very different from you and I. So in this channel, in this community, I've always shared before on coaching ideas. That's why it's so important to subscribe, so you get yourself well educated. And if you want to find someone, look for me below. I'll leave links below. And most people actually make money from property simply because there's a lot more patience, simply because there's a lot of mistakes avoided. When someone invests in property or buys a property, usually it's 10, 20 or even 30 years. And by then, any asset class will have appreciated. When it comes to stock trading, there's so much in and out. When it comes to investing, people think 1-2 years is long. But in this channel, I've shared many times before that investing should be 10 years, then you're guaranteed of doing very well. So with that, let me get changed. Let me roll the intro video and we'll start on this topic. Hi guys, welcome back. And before we start, smash the like button so YouTube knows this is valuable content to share to more people to help them become, better investors and reach financial freedom just like you should. And let's start with this chart over here. You realize that this is a survey. Let me give you some context to it. This survey actually asks people how much of their savings have they invested, and what do you see over there? 0 to 20%, that's the most popular choice. Not doing nothing, that means they have not invested anything at all. That's the second most popular choice. The third most popular choice, 20 to 40%. What can we conclude quickly? You see that the next three selections, invested 75%, invested 40 to 60%, and almost invested everything, there's only 6 people. And if we take a total of 50 people being surveyed, 6 people means 88% of people have invested less than 40%. Why is this so? Let's flip the discussion a little bit different. Warren Buffett, let's look at Warren Buffett. What is he doing? If you see over here in this image over here, you realize, oh, Warren Buffett's favorite stock indicator means that price for the market is still expensive. Warren Buffett is still not investing much. Indeed, it is true. He still holds $128 billion in cash, if I'm not wrong, from reports. And what is this indicator, you may be curious about? This indicator is actually the US stock market valuation to its GDP. Again, the US stock market valuation to GDP. What do you realize? Even after the severe market crash and the rebound, we are still at a significantly high market cap to GDP ratio, similar to 2008 when the financial crisis actually happened. This reeks of overvaluation in the US market. I've shouted out in this community many times, Asian markets look a lot cheaper than US market, but robo-investors go to US market all the time. Robo-investors have this global diversification, and as we know, US market cap is the biggest. That's why a lot is allocated there. Warren Buffett is a US citizen. He's invested most of his monies in US markets. And what we see over there is that, yes, indeed, because of this, he feels that markets are not cheap. He is not investing. Maybe let's pull up the chart back again. Maybe 88% of people are Warren Buffett's. Maybe 88% of people have that same feeling as he is. But let me explain this. There's only one Warren Buffett. The most of us do not make too much in financial markets, do not make too much money when it comes to investing. Why? This 88% is not because they are Warren Buffett. Let me explain. This 88% is very often having this anchoring bias. Let's discuss what is anchoring bias, because this is the fundamental thing that's going to help you become a better investor. And this is a fundamental thing that I input when it comes to each and every portfolio managed that I've done with private clients. So what exactly is anchoring bias? Let me introduce you to this term if you haven't seen before. Look at this over here. Anchoring is a behavioral finance term used to describe irrational bias towards a psychological benchmark. Now let's focus on this portion. Irrational bias or psychological benchmark. If that 88% is focused on 23rd March when market actually bottomed. In terms of S&P, it's 2,200 plus. In terms of STI, it's also 2,200 plus. Everything that they are seeing when it compares to 2,200 is expensive. That is why they are not invested. That is the truth. If the anchoring bias is anchored there, it always feels it can get cheaper. I should buy when it goes back down there or lower. That is fundamentally a very big problem. That is fundamentally trying to justify what is a price with no real fundamental analysis done to it. It's just a bias. 2002 is the price. Right now it's not cheap. I'm not buying. I'm hoping that it comes down. Actually, when it goes down, they're actually not buying. So that's the reality of things. That's why don't predict the markets. That's why buy when in a relative period it's cheap. Start buying. It's so much easier to do it that way. Then you have an anchoring bias. Let's tweak anchoring bias slightly differently. If you are starting to get familiar with this term, there's a second side of it. Anchoring bias also affects when you cash out. I have a private client who asked me, should he be cashing out on these investments because he's broken even? Let me show you this of what I own on the STI index. I also buy STI index across. I bought funds. I'm buying funds actually, and STI index is one of the things that I'm acquiring right now. Let me show you what I've owned in terms of STI index. I've invested a total of 43,000 plus, and what you see over there, close to break even, a negative $5 as of today. It doesn't really matter. Last week it was a plus 1,000 plus. It really doesn't matter, because if we look anchoring price, if that $2.54 is the anchoring price, an investor will be thinking, hey, I have profit. Markets are so volatile. I should cash out, because it could go down back to 2,200. That is a big problem, because when it comes to investing, you have to cut your losers short. You have to let your winners run. I repeat that again, but you have to cut your losers short. You have to let your winners run. If anchoring price is $2.54, $2.55 sounds like a good time to sell, correct? Wrong. That is a bad idea. That is why when you have a wrong anchoring bias, it shapes your investment decision wrongly. $2.55 is not the time to cash out. The time to cash out is $4, because you're looking 5 years, 10 years down the road past this pandemic. Again, you're looking at 5 to 10 years past this pandemic. $2.55 is not the time to cash out. I've not cashed out on this at all, and neither will I. If it goes back down to $2.20, I'm buying more. That's simple. So again, this is a valuable tip. Write it down, because anchoring bias, go research on it. Anchoring bias shapes a lot of mistakes. Two sides to it. One, you are either waiting for a chance to have an illusionary better price, or two, once you're invested, you start to sell out prematurely once you have broken even. These 2 points actually explain why majority of investors don't do well. Again, I'll leave links below if you want to contact me on one-to-one consultation, how to become a better investor and have a proper portfolio to really profit from this crisis. I have previous videos done before on how you should actually do so. So with that, I'll sign off. Smash our subscribe, like, invite you to join our community. With that, I'll sign off. Take care and goodbye.